Good afternoon. Thank you for joining Eleving Group Investor Webinar. The webinar will be hosted by Modestas Sudnius, CEO, and Māris Kreits, CFO of the group. They will provide an overview on the company's business, growth story, track record in the global capital markets, and main terms of the ongoing public offering. We encourage you to ask your questions to the company using the Q&A section underneath the presentation. Modestas, Māri, the floor is yours.
Thank you very much, Marta, and thanks Nasdaq for having us, and then thank you everyone for joining. So as already mentioned, my name is Modestas Sudnius. I'm the CEO of the company, and today it's our pleasure to walk you through, to present Eleving Group, to walk you through our latest financials, to present our newest bond offering, and then of course to answer your questions at the end. So now let's jump right away into presentation. First of all, let's start with what is Eleving Group. So we are a financial technology company which focuses on two main areas. First of all, this is providing alternative financing compared to traditional bank financing, and the second one is mobility services. But for us, of course, financing is way bigger, and in our core of our business. We split it into two parts: vehicle financing, where we have where we're always financing vehicle. Is it a new motorcycle or a used vehicle? And the other segment is consumer finance. And if you look at the split, so around 70% is vehicle financing and 30% is consumer financing. By now, we've already became a global company. We're operating in 16 countries around the world. Here you can see in the map that we actually started in Baltics, Latvia, Lithuania, and Estonia. This is in Latvia and Lithuania. We still have our headquarters where the main knowledge center is based. But throughout the years, since we're operating more than 10 years already, we've expanded into 16 markets, 16 countries, primarily developing Europe, and as of recently, few markets in African region, Kenya, Uganda, and then lately Botswana and a couple of other South African region markets. We have presence around 16 markets, and that really allows us to maintain diversified risk profile, because if you look at our overall group's net loan portfolio, it's rather equally split between all the markets. We have maybe a few outliers, but looking overall, most of the countries have between 5 and 10% of overall net loan portfolio. So really, this way we managed to not be dependent on one country's risk. That has been the strategy from the beginning, and that's something what we continue to pursue in the future as well. Below you can see all different brands what we have in our group. In total, we have 8 different brands, starting Mogo, which is traditional used car leasing. We have Sebo, Tigo, which are consumer loans, to the latest projects where we've been involved, which is Ox Drive. This is green Tesla car sharing business in Riga. And also, last thing what I'd like to mention, that we're a quite experienced company, not only in doing business, but also as being in capital markets. It's, I believe, already 9 years since our first bond issuance in Latvia back in the days. So we have a long track record of issuing bonds, repaying bonds, and this is one of the reasons why we're here with you today as well. But on that we'll tell a bit later. Now, moving on, this is a slide of which we're particularly proud. These are our financials. Looking at those numbers here, we have a period from mid last year to mid 2023. So looking at revenue over those 12 months, we have recorded close to 185 million euros of revenue. It had generated 75 million euros of EBITDA, And the core source of that, of course, was our net loan portfolio, which actually stayed rather stable over the last 12 months and stood at around 295 million euros. But if you would look prior, 5 years prior, we were always constantly growing our net loan portfolio close to 30% per year on average. What has happened over the last 12 months? I guess that's a natural question. So given the situation given the geopolitical situation, given the macroeconomic situation in the world, let's say, and given in general situation in capital markets, we have taken a way more conservative approach in terms of growing our portfolio, and we actually kept it stable. Here, putting absolute highest priority to portfolio quality. What it gave to us that new population through the door starting last year March was significantly better than previously, and that will be seen in later slides when we present our provisioning costs. Also, that kind of allowed us to focus purely on profitability rather than growth, and as a result of that, in 2022 we had 20 million euros of profit this year so far. This, like our recent performance, have also helped us to improve quite a few of our ratios. Quite a few of core financial ratios. One of them being the net leverage, which is currently standing at 3.4 times. And overall, like if you think about Eleving Group, we're a tested business, which is operating already 11 years. And even though now portfolio is around 300 million, but throughout lifetime we've issued close to 1.5 billion euro worth of loans. So our risk teams had a lot of data to test, to bring different hypotheses, and now we do believe that in primarily all the markets we have a very well working concept and business model. And last on this slide, just wanted to also mention that we're one of few, I guess, companies in Baltics which is Fitch rated, which has a rating. So we have a Fitch rating which is B- with stable outlook, and we've had it already for more than 4 years. With that, I'm handing over to our CFO Maris to walk you through the financial figures.
Thank you, Modestas, and good afternoon, everyone. My name is Maris Kreits, I'm Group CFO. Let's continue with financial highlights of the group. So, if we look at the revenue, we actually see, same as with other financial figures, we see a stable improvement in the top line. So, revenue for the last 12 months, if measured by end of 30th of June of this year, is at 184 million. However, given our recent acquisition / obtaining the markets in the Express Credit Group, we actually do expect the annual revenues for this year to land somewhat closer to 200 million range. We're very happy with our improvements in the profitability, which is evidenced by two profitability metrics, essentially one being EBITDA and other being net profit before forex effects. The main driver here, as mentioned also by Modestas previously, has been improvement in the portfolio quality, which has been increased substantially, mainly thanks to the more stricter underwriting rules that have been implemented starting beginning of the last year. I would also like to point your attention to the lower 3 graphs of this slide. So these 3 graphs represent actually our current Eurobond financial covenants, and also these will be in place for the new Eurobond, on which we'll speak later in the presentation. So these financial covenants are following. First one, we have interest coverage ratio. So this is EBITDA over financial costs. If measured for the last 12 months, ending on the 30th of June of this year, we stood at 2.4 times, which is almost 2 times higher ratio than it is required by the Eurobond prospectus, which was 1.25. If we look at the net leverage, so in this instance, this would be net debt over EBITDA. We are also substantially below the required level. So here, the lower the ratio, the better. So we stood at the end of June at 3.4 times, which is way below the maximum allowed level of 6 times. So essentially, this is a kind of a metric that shows the risk of the balance sheet. And lastly, if we look at the capitalization ratio, this is somewhat inverse ratio to what net leverage is, but in our instance, capitalization ratio is measured by equity over net loan portfolio. So here we stood also at the all-time high ratio, which was 27% by end of June. Which is again almost 2 times higher amount than the minimum required level as per Eurobond prospectus, which was 15%. Continuing with the balance sheet, so here in this slide on the left-hand side, we actually see our assets development. Now at the end of June, we stood at close to 400 million euros in total assets. However, what is also very important, together with the growth in the assets, is also our growth in the equity. So essentially, most of the money that we have made throughout the years has been retained with the company. And as we are growing the balance sheet, we're also growing the equity of the company as well. Also, quite an interesting fact is our relatively low levels of cash. Which is actually a huge plus in our business. Not every company is able to achieve that, and so we're able to operate with, let's say, just-in-time cash strategy, which is mainly driven by the fact that we work with the Mintos platform, which is largest peer-to-peer marketplace in the continental Europe, and for us it essentially means the same credit line facility, because we can borrow there in the times when it's necessary, and we can also prepay if that is warranted. If we look at the right-hand side on the liabilities, you'll notice that the largest portion of the liabilities would be our larger 150 million euro bond, which is listed and is trading in both Frankfurt and also Nasdaq. No, I'm sorry. So this bond is trading only in the Frankfurt's regulated market. Then we have the second largest bond. We have our local bond issued by our local subsidiary in Latvia, by AS Mogo. This bond is in the size of 30 million, and this bond is trading in the Baltic Stock Exchange. And this bond is maturing in March of next year. And this is actually the main subject. This bond specifically is the main subject of our today's presentation. And we also do have an experience with issuing some other local notes, such as notes in Kenya, which currently at the end of June stood at 12.9 million. However, given the quite large demand, we expect that figure to reach 20 million by end of next year. And of course, also, as previously mentioned, we work with Mintos platform, which at certain times has been as high as 100 million. Now we stand at 67.5 million euros. And one also notable thing we would like to point out here is that this year, Eleving Group received an award by Nasdaq Baltic for best investor relations in the First North bond list. Continuing now with the product overview. So starting from left to right, let's start with our core and main product that our group offers. So this is the accessible traditional leasing or sale and leaseback product, which we offer under Mogo brand name. This product is offered in most of the markets where we operate, and it basically is characterized by the fact that it is geared towards financing the average car that is driving on the streets of every country where we operate. So maybe not many of you would know that, but let's say average age of the car for example, in Europe, same as in Baltics, is somewhat in the range of 9 to 10 years. So not always every customer is able to purchase this car either with his or her savings, or also not in many instances banks are helping to do that. So here we step in and we provide this accessible solution for these customers. Now, as we have grown and developed over time, we are now offering also a more premium card solution. This is the same leasing or sale and leaseback transaction under Primero brand name. Currently, this product is being offered only in Baltic countries, but there is quite a big potential for that product to be scaled up across other markets in our loan portfolio. Then continuing on, as we evolve as a company, our customers are also evolving, and let's say we try to follow the recent demands from our customers, and this is where we have introduced the rent to buy product under the Renti brand name. So this is a more flexible solution for those customers who are not maybe ready to commit for let's say specific term, be it 6, 7, or 8 years of leasing, but they would like to have the flexibility in terms of returning the car, changing the car after certain periods of time. For them, we have this solution. Moving on, in our African markets, in Kenya, Uganda, we're actually quite happy to offer a Mogo branded solution that finances brand new motorcycles. So the motorcycle is actually the most common motorized vehicle in the Africa, and every customer that uses our product is essentially either the same or next day is out and basically earning money with this motorcycle, being the groceries delivery, taxi services, or cargo services. What we're doing here, essentially, we're financing micro entrepreneurs. Then, as mentioned previously, we do also offer our unsecured consumer loans. These loans are being offered currently in the Southern Europe as well as in some of the African markets. So these are smaller ticket loans if compared to vehicle loans that we offer in the other brand names. So these loans are mostly used to, let's say, finance electronic or white good purchases or anything of that sort. And lastly, this is also one new addition in our kind of this fully vertical mobility solutions or mobility products offering. And this is the, let's say, the solution that addresses the shortest mobility need that's out there. So this is our investment in the car sharing application, which is Ox Drive. We're majority investor in this project, and currently this project is focused only on Latvia, but with a great potential to be scaled up also in other European markets. I'll hand it over back to you, Modestas, at this point.
Thank you, Marius. Now let's look at our lending process. In a way, if you've seen our lenders' presentations, you've probably seen something very similar. This is processes are rather the same, but what I'd like to emphasize here is digitalization, what we managed to achieve through the years, and automation. So just if we would look at last 12 months, we actually processed close to 1 million applications. That means around 100,000 applications per month, and for that we obviously needed quite automated solutions because we would not have such scale of workforce to process all of that. So in most of the cases, underwriting process is fully automated, which, to be honest, I think is done in quite a few lenders these days as well. But from our side, since 70% of portfolio is also vehicle, there's vehicle behind it, which also is very important to evaluate. And you know how in our business we say that you can't ever trust the dealer, so you need to really identify what is your price, what is the real price of the vehicle. For that, we, for example, built, I would say, unique in the market automated vehicle valuation tool, where we're getting prices from all over the world, different car portals and so on, and really finding the equilibrium, finding this average price of vehicle of those particular kind of conditions and details. Also, if you look at the debt collection process here, it's quite intense, but at the same time very automated, using different robocalls, using quite automated processes, how we track customers which don't pay. And as example, again, on the vehicle finance side, we have GPSs installed in most of the vehicles. So all of that, all this automation really allows us to have this seamless process and to have a competitive edge over most of our competition. Moving forward, a bit more about our sales channels. So of course, digital is the most important channel for us. We have probably close to 50 different online tools, let's say, whether it's a product web page, whether it's our own car sales portal where we're promoting the cars which have been returned, or best dealers with whom we work cars. But at the same time, important role is being played by offline channels. So first of all, our branch networks combined across all the markets, we have close to 250 branches. Sometimes it can be just a desk in a shopping mall where we offer to finance mobile phones. But the fact that we have this offline presence brings us two things. First of all, we're able to reach a wider population, because some still prefers offline channel compared to online. At the same time, it also brings additional underwriting tools where we're always seeing a customer in place. We can ask additional questions with different security measures in these circumstances as well. And but of course, 250 branches would not cover the whole countries, since we have 16 markets. How we do that in most of the cases while working through dealerships, typically used car dealerships. We have more than 2,000 of them, and each dealership has our own IT tools, our own applications, and using them, they're able to provide all the necessary, to collect all the necessary information from the customer so that we could give an offer in a timely manner. And we do that, and that's a win-win for the customer, who can while coming to pick for car, he can get a financial offer in the same stop, same visit, at the same time for the dealership as well, because of course they're very motivated to work with a partner as us. And this way we're able to cover then really whole population and kind of be present everywhere where vehicle sales transaction is happening. Yeah, moving on, another topic which is important for our companies is different activities and projects what we do to support our 5-year ESG strategy. Of course, we do understand that our core product is financing the used vehicles. So environmental issues are on the table for our company, and we have multiple initiatives, products, how we tackle that, from already mentioned electric car sharing to offsetting CO2, to providing first electrified motorcycle financing offers in African region and similar. Also, if we look at our initiatives in our ESG strategy, we invest a lot in our financial literacy tools, where in an interactive way we're trying to teach our and the potential customers how to plan their financials better, and many different other initiatives from both internal, external, a lot of employee and then gender diversity driven. So that's something what we really pay a lot of attention to. Moving on, I guess it's now time to talk about the actual instrument what we're offering, and handing over to you, Mario.
Thank you, Modestas. So maybe before we speak on the actual or new instrument, it's worth to notice, let's say, all 3 bonds that we have currently outstanding that are trading in European capital markets. So just a super quick recap. Firstly, we have the largest Eurobond, which is in the size of 150 million Eurobond euros. That bond is offering a 9.5% coupon rate and is being traded currently in Frankfurt, Germany, and maturing in year 2026. We also have issued in year 2021 a subordinated bond in the size up to 25 million euros. That bond carries a higher coupon rate with 12% plus 6 months Euribor, and that bond is maturing in the year 2031. This bond is being traded in both Riga as well as Frankfurt, Germany. And lastly, as previously mentioned, we have this local Latvian bond in the size of 30 million, which is currently offering 11% coupon paid out monthly. However, this bond is maturing in 31st of March next year. So in the anticipation of that, as of this moment, we are offering currently for every Latvian bondholder or every bondholder into our Latvian bonds, irregardless of where let's say the investor is domiciled. So basically, we are offering a swap option into a new bond. The new bond is in the size of up to 75 million euros. We have certain flexibility there. Anything in the range from 30 to 75 million euros would make sense for us. The coupon rate is, given the current market conditions, is adjusted and now is fixed 13%, with the coupon payment being quarterly coupon payment, and this bond is expected to mature in 5 years in year 2028. This is what's quite important is that this is a Eurobond version of this offering. So basically, this is a senior secured bond, unlike what we had previously in this Latvian bond, which was unsecured bond. So now what we are offering our current Latvian bondholders an exchange offer into, as we would like to think, a better offering from, let's say, risk reward perspective. So hence we have this diagram on the right hand side as we try to kind of portray it. There's a higher coupon rate, however, also at the same time, also lower theoretical risk because of the secured structure of the bond. So, and this bond is sort of, as we like to say, a mini version of our larger Eurobond. And this new bond is also expected to receive a Fitch rating. So it will be only a second rated bond in our loan portfolio, together with a higher 150 million euro bond. I guess what to move to our next slide. So here would be a proposed transaction terms. I would not kind of go through all of them, maybe just highlight key aspects of it, but I'm sure the presentation will be available in the exchange as well as in other media. So feel free to come back to this slide and familiarize yourself with the more details on this offering. But again, on the key aspects of this bond, this is a senior secured bond, which is being guaranteed by other subsidiaries or group subsidiaries of Eleving Group. And we are also offering securities. Securities in this instance would be loan portfolios in two of our mature markets in Georgia and Armenia. We're also offering share pledges in those two markets and also bank account pledges. So this bond would be in the size up to 75 million euros with a fixed coupon of 13%, 5-year term with the bullet payment at the end of it. You'll also see that the covenant structure is pretty much exactly the same as for the larger Eurobond that we have currently outstanding. And so basically the bond is compiled under Luxembourg law and is expected to be traded in Riga as well as in Frankfurt's regulated markets. And maybe lastly on the term or timeline for this offering. So actually this is the last week where all current bondholders into AS Mogo bond have an option to swap their current bond into this new bond. Again, as we would like to portray a better offering from our perspective, from risk-reward perspective, because higher coupon and let's say securities attached to this bond. The exchange period expires on Friday, on October 13th. So everyone who's interested in this bond, please make sure to visit our webpage and follow all the instructions kind of given specifics of where you keep the bond with which bank. So there are different nuances how the bond can be swapped into a new one depending from bank. And lastly, simultaneously, we also do offer an option for every existing bondholder, as well as for any new potential bondholder to purchase or subscribe towards these bonds. The subscription period is actually 1 week longer, so this period will end by end of next week. So for everyone who's interested to subscribing to these bonds, you basically have two more weeks left to make the decision and get in contact with your bank. Again, you can find all the information in our dedicated webpage for this specific bond offering, invest.eleving.com. So feel free to follow the link here also shown in the presentation.
Thank you, Modestas and Mari, for the presentation. Now let's proceed with the Q&A session. But before, reminder to all the attendees that you can still ask your questions to the company, and please use the Q&A section for that. Let's proceed with the questions which were submitted before the webinar, and let's start with the ones about the bonds. So the first question, tell more about the bond proceeds and sources for the repayment up to the maturity, please.
Mm-hmm. So the bond proceeds will be used first and foremost to repay current Latvian bond. So let's use a theoretical example of 75 million euros. Out of those 75 million euros, 30 would go to replace Latvian bond, and the remainder will be used to pay back our kind of portion or all of the existing liabilities. So the most obvious one is Mintos liabilities, which currently stand at 67.5 million euros. So let's say extra 45 million can be easily go there to refinance that portion of our liabilities. So essentially, we're not increasing on a day one. We're not increasing group's leverage. We are let's say repaying some of the existing liabilities.
Thank you. And the next question, if interest rates go up, is there a chance for higher coupon rate?
The coupon rate for this bond has already been announced. So this is a fixed 13% rate. We deliberately tried to put or fix in the rate that would, let's say, satisfy the most demanding investors, given the current market dynamics. So we believe this is a good offer also for those investors who would like to really capitalize on this high interest rate environment and really lock in high kind of return instrument for their holding for quite a long period of time for next 5 years. So compared to some other bond offerings that you saw, and comparable notes, this is one of the highest coupons that we are offering currently.
What kind of risks do you see in 5 years period? What kind of risk management systems there are in place to manage that?
Okay, in terms of risks for next 5 years, I guess looking at previous 3 years, it's very hard to predict. I guess for businesses as ours, still main risk is customer payment discipline. There could be also other risks related to higher inflation, which we actually already see when company costs are becoming higher, while and also kind of it brings back to the same topic of customer payment discipline. How do we manage that as a company currently, and how do we plan to manage it in the future? So first of all, it's all about credit underwriting, and we've once we realize that in upcoming months there might be a bit higher pressure on our customers meeting their liabilities, we already changed our underwriting methodology, so they are still in place. Also, in this period we chose kind of stability and then gradual growth more than accelerated growth when it comes to our net loan portfolio, because we also think that managing liabilities for companies is also very important. We do believe from what we've already presented that we're doing it quite well, and we do it always in advance, and this bond issuance is exactly what we're doing again. So that's another thing. And lastly, is business model, whether you have a tested business model or no. Like we're operating in market already 11 years, and I think for some markets, COVID, it has been also an ultimate test, because we're financing a lot of taxi drivers, cargo drivers, and for them, they had periods where they could not work at all. So our portfolio being 70% of our portfolio being secured, we know how to deal not only to issue loans, but also how to deal with problematic customers. And I think we've proven it already multiple times. So we are not, for our business model, default is not a very bad scenario. Often we can recover biggest part of our loan in case of this unfavorable scenario. So all of that, I believe, put us in a good position for any upcoming uncertainties in the future.
Thank you. The next question about the bonds. How liquid are the bonds? Can they be easily sold with help of the bank?
Yeah, so I guess two parts of answering this question. So in theory, if the bond is listed in any of the, let's say, reputable exchanges such as Nasdaq Baltic, or let's say Frankfurt Börse in Germany, so the bond is tradable. So if there is sufficient kind of supply and demand, there's quite a bit of opportunity to, let's say, exit or even add to your holdings. It really depends. So our experience shows that the liquidity is larger in the Frankfurt exchange than it is, for example, in the Baltics. From one aspect, it makes sense because let's say the investor pool is larger in Frankfurt than it is in the Baltics. But yeah, so it depends. It depends from multiple aspects. However, again, in theory, the bond is liquid, is tradable, and this is why we always strive to list most of our bonds in the regulated market exchanges in the anticipation of the highest possible liquidity.
Thank you. Is it possible to withdraw the money before the maturity date of the bond?
I guess this question goes hand in hand with the previous question. So the possibility to quote unquote withdraw the money is really through the use of exchanges. So every investor has the opportunity to, let's say, put an order out in the exchange through the use of their bank infrastructure. So the possibility is there.
Thank you. What's the effort of the company on matters relating to ESG? Can you please highlight some of the things you mentioned already?
Sure. So as mentioned, like ESG, that's an important part of our operations and our focus. I'll mention a few things from related to the product. So first of all, we already kind of invested in electric vehicle car sharing business. So this is basically zero CO2 emission mobility project. We're also being one of the first, if not the first company promoting electric mobility in African region through financial projects. We've done a project with Bolt where we're financing electric motorcycles for taxi drivers. Now we're doing with another company. And lastly, we're offsetting our headquarters CO2 emissions. And from financial aspect and the social aspect, we do invest a lot in our interactive tools, which allows current and potentially future customers to plan their financials better and to better understand what kind of liabilities they can take on themselves.
Thank you. Now let's proceed with the questions we have just received. So first one, what's the EBITDA distribution over the different brands?
Okay, I guess the question is a bit too detailed for us to answer on spot, but roughly, and maybe I will not answer the question by brands, but let's say I'll answer it by product groups. So if we use the same example as was mentioned previously also by Modestas multiple times, so our portfolio distribution is roughly 70% secured vehicle segment and 30% would be consumer loans. So in terms of EBITDA, the proportion is somewhat similar, maybe slightly more tilted towards consumer lending business because of the higher yielding products that we offer there. However, largely think about the similar proportion for these two segments of our business.
Thank you. The next question, the bond coupon is fixed. Meanwhile, your business offers a variable risk profile. How do you plan to match it or hedge it?
So maybe firstly I'll answer it from the P&L top line. So revenue, actually our product offerings that we offer to our customers are also fixed. So there's a fixed interest rate products that we offer. So basically in this instance, customer is paying fixed interest rate, and we would also be paying fixed interest rate on our liabilities, which then makes sense, or actually there's no need for hedging in that aspect. Where the different risk components, variable risk components are introduced is basically in other cost line items such as cost of risk, admin, cost of admin, and etc. So I believe we covered quite a bit of those in the previous in our presentation, where we mentioned that we are trying to control the cost of risk with a stricter underwriting. Hence, our portfolio has improved substantially, and we're also quite focused on the operational efficiency of our group. So hence, we're trying to control the other or the third portion of our P&L expense segment, which would be admin or OPEX expenses.
Thank you. Where is the growth market for Mogo or Eleving Group?
Yeah, so previously, if you look at the last few years, we were growing the most in African region. However, already last few quarters, the growth are kind of flattened. And now what we see and what we project in upcoming quarters, that the growth will be rather equal across most of our markets, varying from 5 to 15%. So we do believe that in all of the markets, we are quite well-known brand, and we want to kind of focus on organic growth in these uncertain times, not over-investing into marketing expenses. So let's say relatively balanced growth across all existing markets.
Thank you. And now let's proceed to the last question we have currently received. What's the dividend policy and how much cash leaves the company in the next years?
So first of all, worth to mention that until a few months ago, we never paid our dividends before. So all the retained earnings stayed in the company. Just recently, we paid our first dividends. And also that's seen in our capitalization ratio, which has been strengthening over last 3-4 years. As of this moment, we don't have a, let's say, public dividend policy because let's say, there has been quite a few uncertain years in the economy and so on. We do plan to introduce such policy, I guess, very likely next year. What we know as a management and our shareholders' commitment that equity growth will follow portfolio growth, so that we do not anticipate, like we do anticipate that our capitalization ratio will be growing further as well. meaning that we would pay out just as much as so much dividend so that we would still have enough to strengthen our capitalization ratio in following quarters. And afterwards, we do believe that we'll have a public policy in place.
Thank you. We have received one more question. Are you thinking of an IPO anytime soon?
Let's say equity exercise, which could end up in form of IPO, is currently under discussion in our company. We do believe that we're quite ready for that as a company. Of course, time in capital markets maybe not ideal as of now, but that's something what we definitely gonna anticipate while thinking about our next year's strategy, and hopefully we'll be able to provide a bit more news in public channels in upcoming quarters.
Thank you, Modestas and Mari. All questions are now answered. The recording of the webinar will soon be available online, and we encourage you to follow Eleving Group announcements to stay up to date with the company's news. Thank you for joining today.
Thank you.
Thank you, everyone.